Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Interesting because once again we are at 11,075. So, yes, you would want to call this a breakout. But today what's been interesting is that the market breadth is quite decent. As we discussed, the mid caps, the Nifty Junior, across the board buying is what you have seen today. That I think is more heartening part for the bulls, especially the way the mid caps have moved over the last 2 days and the way junior index has moved. Now approaching a 500-point rally on the Nifty Junior. Does look like that 600-point down day that you had perhaps was at least a bit of a near-term bottom in place for the junior index. Ashwani and Mitesh with us for BTST calls. Ashwani, do you think this move on index should be chased? And what about individual stocks?
See, if you still see, large private banks are sitting out, HDFC, Reliance. So that way, if they would have also participated, you would have gotten a big, momentum push on the upside. But for whatever it's worth, I think people should now try to get long on the Nifty Junior and maybe through an ETF, because this has been a significant turnaround. And based on news, plus the market is almost touching new highs. One of the indices had to turn around. Either Nifty should have turned down or Nifty Junior would have turned up. So one of these things have happened. So let's see if the breakout works. But overall, it's a 200-point at a time style breakout that you want to play. Don't assume that now it's 12,000 and 11,500, etc. That sort of breakout. Having said all of that, I think the clear trend from today's news is the consumer discretionaries. So Bajaj Electric is a buy with a stop of 588, target of 620. Johnson Controls is a buy with a stop of 2100, target of 2230. And Havells is a buy with a stop of 600, target of 635.
Okay, so all the TVs and the white goods and the washing machines, those are the stocks that Ashwani is going with. Mitesh, what's on your list? Mitesh?
I have two buy calls as well. State Bank of India is getting into some kind of an positive zone, so that's why with a very tight stop at 261.5, look for target of 275, more a BTST kind of call. And Repco Home Finance looks very good, buy with a stop at 580 for targets of around 650.
Okay, all right, those are the half-hour calls for today. It's Monday, which means it is time for Midcap Mania. We've got Nigel joining in. Let's find out what stock is on his radar today. Nigel?
Well, it's an interesting one we are bringing to you today on Midcap Mania. Well, remember, midcaps are out of favor. We have been talking about that. We're talking about a company whose profitability is the lowest we have seen in more than half a decade. And in fact, it's a textile play. So it's a cocktail really of bad news. The company that we're talking about is RSWM. The market capitalization as of now is nearly around 550 crores approximately. But in fact, it's coming off a very, very weak set of, a weak FY18 odd. That's the company. It's a Bhilwara Group company. Those are some of their brands. Mayur is in there, and they also have a denim brand as well. But moving on then, I was telling you that the last year was bad. Well, you had demonetization, the lingering impact of that. You had GST implementation and the hangover and, sorting out issues on that front. Raw material costs, both power cost went up. You had raw material costs as well that did spike out. And the rupee was stronger. So on their exports, they were not making that much money. So these were the challenges in the past year. And if you pull up, the last year itself, you'll see that the profitability was at its lowest levels we have seen in the last 5 to around 6 years. It was only around 15 crores odd. But what was interesting is, in the last few quarters, the profitability really has improved. That, in fact, is the dividend payout. Remember, even when the profitability is lower, they're paying out roughly around 25% to around 30%. That could be viewed positively. But what will be viewed more positively and what we're going to be looking out in Q1 FY19 numbers is, can this, this U-turn that we saw, can it improve going ahead? Because it was a net loss and Q4 was quite good. It's a seasonally strong quarter as well. But we'll have to see whether or not Q1 numbers can be that well as well. What is the capacity? Around 4.7 lakh spindles. And if you break that up, most of it is really synthetic based, while a smaller part of it is cotton based. So there's volatility in terms of crude prices because polyester synthetic, yarn gets more impacted by the crude price spike. Breaking it up then, grey, that's around 56%. But melange, that in fact is a higher fabric that you normally sell or higher quality yarn. That's only around 13% all. That's a cotton-based yarn out there. But pulling up the next slide then, you'll ask what's the geographic breakup? Exports are around 30 to around 35% odd. So with the weaker rupee, they could gain some part on that front as well. Well, if you break it up, most of it is yarn sales and a smaller part is denim as well as fabric. There has not been any big growth on either of these segments, so we'll have to keep an eye out on that factor. Well, what are the key triggers then going ahead? The government now, they are trying to sort out this entire GST and the way it's implemented. So that's one part. They've expanded their captive RPF. That's a recycling polyester fiber. That reduces the volatility in fiber prices. So that could be one factor as well that we could be looking at. They have upgraded a couple of their spinning capacities, and also they use around 11 lakh units of power. Now around 8.2 lakh units they get captively. They are commissioned a couple of new plants. So let's see whether or not their captive consumption of power goes up. That's what will help them in terms of margins, because remember, power cost per unit has gone up to around, nearly around 5 to around 6, even 6.5 rupees per unit. Well, that's going to be very important. These are the input costs, cotton, polyester as well as viscose. Those prices have been going up, so we'll have to see how exactly they pass this on, because they make money on the split of these inputs as well as yarn selling price. Debt in its books, it's a textile company. They have debt of around 1,400 crores. They're borrowing at around 8.5%. We'll have to keep an eye out how exactly they're going to reduce that. Remember, this is a company that belongs to the same group as HEG. So it's quite ironic. HEG is at a lifetime high, and this in fact is at a 52-week low. Why are we relating it? Because they have nearly around 10 lakh shares approximately in HEG. You have to apply at least a 70% discount out there. That's around 120 crores approximately. In terms of valuations, it gives you valuation support out there. Key points to track. How do they maintain this spread? Input costs and yarn costs, that's going to be very, very important. I told you that the numbers were improving in the last few quarters. Can they continue to improve? That's going to be quite important as well. And in the last couple of years, they've incurred a debt, capex of around 200 to around 250 crores. Will there be any debt reduction in this year? Very, very important. And no real growth is what we have seen in terms of the revenue. So where does the growth come from? Interesting company, a couple of large mutual funds hold stake as well. Promoters at around 50%. You have L&T Mutual Fund, you have IDFC Mutual Fund, as well as a known investor, Dolly Khanna, that holds a stake over here. But the stock has been struggling. Let's see what happens from here, but a rather interesting one. Back to you.
Okay, Nigel, thanks a lot for that. Let's invite our next guest. Then we have Tahir Badshah joining us now, CIO Equities at Invesco Mutual Fund. Tahir, hi, good afternoon. To have you on the show. Interesting. Just looking at the Nifty Junior right now, the mid-cap, there's been quite a bit of buying over the last 2 or 3 days. Do you reckon that, there's some portfolio buying which may have once again started after the kind of big decline that we had seen in the broader market?
Yeah, it's quite possible. I mean, we've seen a fairly sharp correction in several parts of the mid and small cap space, and like I probably remember mentioning that last time on your show as well, that some of these are coming into a zone at least where many of these stocks are in a position to be evaluated, because valuations have kind of corrected pretty sharply from where they were about 6 months ago. Maybe, I mean, if it is a situation where investors are interested in making money over the next 2 or 3 years, I think the mid and small cap space over the next 3 to 4 months or 3 to 6 months over the volatility will offer a good opportunity. That's what has happened exactly even in the past. So as you remember, mid-cap rally probably began in 2014 before the previous election, and I think people who have invested in the mid-cap space and small-cap space in 2014 are still in the money even in 2018 after this correction. So I think it makes sense to buy into this weakness, but provided you have an horizon of the next 2-3 years to make your returns.
Okay, so stay patient if you're willing to mid caps now. Good afternoon. I remember our last conversation when you said that you were quite optimistic on autos in all its formats, OEMs, auto ancillaries, related plays. Now, since then, a couple of interesting things have happened with sector leaders. We've had this whole truck overloading issue play out. It's taken Ashok Leyland down to 52-week lows. We've had Bajaj come out and tell us that this is a company that's really fighting hard on market share. And I mean, look at the pressure today on both the two-wheeler twins, actually even on TVS Motors. How are you approaching some of these plays within auto, two-wheelers, and then let's talk about the truckers?
Yeah, so both the cases are, pretty unexpected. One was, of course, regulatory risk, which was in a way not anticipated, and the other one was aggression on part of one of the players, which is still yet to manifest. But of course, the market is taking very solid cues out of the statements of one of the competitors, and reacting on the basis of that. Yes, in the short term, of course, these things have clearly come under the pressure of some of these announcements, but in both the cases we have to see whether ground level changes actually happen. So, for example, even in the case of the whole trucking related or freight related regulation, we need to see exactly what happens on the ground, and probably the next 1 or 2 quarters volumes might probably continue to remain a little weak just because of the confusion. But exactly what happens in terms of the impact on volumes will remain to be seen. And second, also in the case of the two-wheeler industry as well. So while competitors spelled out aggression, but we'll have to again see as to what exactly manifests. Actually, tailwinds are there for the industry. So we've seen possibility of rural demand being a little stronger. There has also been evidence of numbers for the two-wheeler industry actually having been better throughout the whole of last year. So I think top-down argument for some of these stocks continues to remain, and probably this correction might offer an opportunity as well going forward. So I think we have yet to probably see the actual impact of some of these pronouncements which have been made by some of these companies in this regard.
Tahir, in your Invesco India Contra Fund, some of the top holdings are HDFC Bank, HDFC, Reliance. I mean, these are the stocks which have actually supported the market, and there's actually been over the last 6 or 8 months a lot of buying here. So it is hardly contra now. So I mean, I wanted your thoughts on whether you would be making any changes to this kind of portfolio.
So not yet, at least in terms of some of the names that you mentioned, simply because of the fact that Contra will continue to own some of these positions till the time valuations really become untenable, and they are yet to get into that zone in some of these names that you mentioned. I mean, they're still growth at reasonable price, or maybe evolving, or probably even cheap as such in a few cases. So Contra typically follows a philosophy that you buy something which is cheap, and when it gets to a stage when it is actually really very expensive and growth at, let's say, unreasonable price, then that's the time we would probably take a call to exit out of these names. We've done so in a few cases. So if you see the portfolio changes, some of the large cap companies which have risen very sharply in the recent past have been exited out of the portfolio. So it's a case-to-case basis. Some of these names that you mentioned are still, in a way, a growth at reasonable price at least, and therefore decent value at this stage. Not cheap, therefore, but not very expensive either, and therefore somewhere in between, and probably we still continue to hold on to them for some time.
The reason I asked is, for example, 3 or 4 days back, Kotak said that perhaps there's some stress. For the first time, we have seen HDFC Bank really disappoint a bit, both on NII and profit. So is there a case that even some of these hallowed companies might be now facing some stress?
Yeah, I mean, at the margin, maybe a quarter probably is always a difficult thing to go by and make conclusions. Besides, these are very solid quality franchises, and not very susceptible to some of the challenges which we are facing in the system as a whole. So we would be keeping the faith in some of these names. Of course, not all of them are part of the Contra fund, but like as I said, Contra really goes by the philosophy that we don't tolerate very expensive valuations, and if it comes to that stage, then we'll take a call irrespective of whether a company stumbles a bit in a quarter or not. So that's probably not as much of a defining characteristics. We need to ensure that some of these are reasonable in terms of the valuations, or maybe even cheap for us to continue holding on to them. But otherwise, as a general kind of a statement, yes, I mean we have to monitor all of the names that we have in our portfolio. But we don't really want to get swayed by one quarter of somewhat weaker than expected numbers.
Now, when I look at the top 10 holdings, Tahir, I don't find too many consumer names, barring, of course, breweries, and Maruti could be a play on consumption, of course. Is that because of valuations? And now, in light of this mini GST stimulus of sorts, would you look at adding anything, particularly on the mid-cap side, whether it's appliance makers, whether it's shoe makers, etc.?
So maybe they don't figure as part of a top 10, but there are a few of them, probably not the direct plays, some of the indirect beneficiaries and some of maybe even the consumer durable names. And it's very difficult to have the most happening stocks on a particular day to be part of your top 10 in all your funds. So that's something which is obviously not an achievable. It's not a practical thing to have. So, but yeah, we are positioned wherever we've, irrespective of whether GST has happened or not, wherever we felt that the fundamental case is reasonably attractive from a medium to long term. I think GST has been helpful to a few product categories, and maybe there might be a few more over a period of time. The last is probably not out on this as yet. I'm sure we have a lot of these things to go from now until the next election. So I guess we'll see along the way as to how we fare across various positions. But we have a certain presence, not that we are completely absent.
Oh, yes, no, I take your point, Tahir, because I think your NAV would tell that, but you got perhaps some of the most of your stocks are close to lifetime highs, Surabhi. So
yeah,
I think I have to go.
No,
I was just saying.
I'd just like to add that for us it is.
Go on, Tahir.
No, I just wanted to mention that we go on the way we evaluate it is based on what kind of overweight positions that we have, and typically we don't buy any underweight positions in any particular individual stock. So while they may not all of them figure in the top 10, but we may have some of those positions which relative to the benchmark at least might be overweight. And if they are, then and they will be, then if they move and if they perform, then obviously we benefit more than the benchmark. So that's how we operate. Not necessarily that everything has to be among the top 10, but if we are overweight, that is good enough.
Not at all, Tahir. I was just wanting to ask whether you would add even more despite the valuations. That was really the underlying question, not to say that top 10 is the only part of a fund.
Yeah, not so sure. Absolutely. Yeah, but yeah, to answer your question, therefore, so now that everything is attractive now at these valuations, yes, we've sifted through some of the investable options that we have in the FMCG space and even in the consumer category. We've located a couple of them which we think are still worthwhile, despite the kind of valuation surge that we've seen in many of these companies. So we are happy to buy some of those which probably have not yet participated or maybe are still cheap relative to their fundamentals. So I think that's how we are kind of attacking this situation.
Okay, final question from my side. I believe you've now started to look at some of the road companies after the big decline, and perhaps adding some of the smaller consumer companies like perhaps a Parag Milk as well. Your rationale for that, Tahir?
So, like as I said, we are some of these have turned cheap, and where they are based on certain specific characteristics that we want to see out of these companies. So in certain cases it could be just pure cheapness. In some of these cases it could be the possibility of they having done some reasonable investments in the recent past, and either in capacities or in brand building, and you probably are looking for operating leverage to manifest over a period of time, and maybe even accompanied by cheapness. So I think it depends on individual attractions as to what is driving that story, and that is how we are kind of, so like I said the last time as well, that many of these road companies do look cheap, and compared to what they were probably 6 months ago, and the fundamental rationale has probably not completely disappeared. Maybe there have been certain challenges in the interim, like for example bank funding for some of the projects and so on, but otherwise road project intensity continues, awards continue, so and valuations have become cheap, so I think they become interesting from that perspective.
Okay, it's an interesting thought to leave this conversation on. Then thanks, Tahir, very much for joining us this afternoon. That's Tahir Badshah with a call on the kind of themes that Invesco is liking in the market right now. Speaking of the market, it is up and away, Anuj, 11,090. this is looking, I don't want to jump the gun, but at least we've crossed a couple of those levels. That 70 zone has been breached for now.
The 70 zone has been breached, and I think once again, you would want to give more credence to moves where you have market breadth. Today looks like a day where people have participated. They've got their stocks moving. I think from the last time we spoke, the junior has put on some more weight. The mid cap index is right now at the highest point, and that gap between advances and declines is now increasing. Just pull out both Nifty Junior and mid cap. I think Junior is the index to track from here on, Surabhi, because the Nifty is at all-time high. That's okay. We all know that. We're closer to all-time high. Doesn't feel like all-time high. When will it feel like, the market's doing well? When Junior starts to do well and the mid-cap start to do well. Small caps, I mean, there would be rallies here or there, but, we all know how vulnerable those rallies are. But the good quality stocks, this is where, the market had a fall in line with, what was happening in the broader market beneath the surface, the B group and below that. That is where the problem was. If you start to see rally in the junior, I think that would be a sustainable rally. I mean, if that along with the rally in the Nifty will be more sustainable rally, if, it's backed by the market breadth.
Well, it's so far so good. Bulls in control. Let's take a break. We'll count down to the close of what seems to be a very solid Monday session.
Welcome back. Counting down to market closing. It's been a good day for the bulls. For the record, the Sensex has hit all-time high. Of course, we've been discussing that, the narrowness of the market. But today, perhaps, it's a move which is better than the last few moves where it was just about index. Today, there's been a broader market participation as well. Ashwani, your thoughts on the latest move? Today, if we close here, it would be above that zone. 11,050 looks like decisively being taken out.
See, what you have to see is that what are we saying? That elections don't matter? Or is this the pre-election move without even one opinion poll? So, think markets in this sort of a mood can trap. So taking it, couple of 100 points at a time may be a good news. Whatever happened today, GST was a coincidence. The rally started almost on Friday, maybe a couple of more days of rally. Then what takes us higher? So, it is a breakout. I think enjoy it while it lasts. But I won't think that we are going to run up before the election. Last time, to 2014, the rally started 15th of December. I mean, it is only July. So my sense is, yes, it's a couple of 100-point type breakout, but it is not the breakout which goes to, 11,500 or 12,000, because there is still lots of time left for a major trigger.
What else could take it higher? I don't know, crash in oil prices, the US turning benevolent to India on tariffs. If only wishes were horses. But that's on a lighter note. No. Let's keep it serious for now. Mayuresh Joshi of Angel Broking is joining in. Mayuresh, first stock to you would be UPL. 16% rally after serious drubbing last several months. So bounced from the 52-week low. What would you do with the stock?
Oh, so afternoon, Sulbi. So if I'm holding on to the stock, I clearly hold on. Yes, I think from a near-term perspective, you might actually see debt levels going up because of the $3 billion debt that the company is taking on at this point of time. And that also does take its net debt to EBITDA levels higher. What it also does, probably from an immediate short-term perspective, is reduce its return ratios because of the implied interest costs, which will be far higher over the next few quarters. But then there is the offsetting effect in terms of the synergies coming in from day one. So as the management has put forth $125 million year one, you're probably looking at $200 million. And again, I think the kind of benefits that they'll get, specifically in terms of the geographical locations, Eastern Europe, Russia, the product mix, and the exposure probably to LATAM probably getting reduced in terms of a geographical risk, specifically in terms of standalone UPL operations. I think the European operations will now contribute close to 24% for the merged entity, and LATAM staying at 32%. So I think the earnings growth should probably come through. Obviously, I think there are vagaries in terms of how weather patterns and all can develop over the next few quarters, and that uncertainty always persists with these stocks. But the long-term outlook probably remains robust. The reduction in terms of return ratios from a short-term perspective, I think the markets are probably taking into account more the synergies and the earnings outlook for the stock. So anybody holding on to UPL, clearly hold on to the stock.
Okay. All right, gentlemen, let's take a quick break. We will come back. It's a strong afternoon of trade this Monday. We'll look at the close with the Sensex and the Nifty close to record levels. Welcome back. It's more or less holding. I mean, there's no sort of fall from grace, at least as far as the Nifty and the Sensex are concerned right now. We are in conversation with the experts. Ashwani, I want your thoughts on what to do with these two-wheeler stocks in a market that's largely buoyant. I mean, this pocket is coming under stress. If you're holding them, then what should the call be? Bajaj, TVS or Hero Moto?
See, if you are holding them, you should have been out by now. Basically, these are not going up anywhere in a hurry. They are trading ranges. And right now, almost all of them are heading to the lower end of their ranges. So at some point, they will become buys. But do not buy them before they start turning. I think if you buy Bajaj Auto around 25, 2600, 2 quarters from now, you know, all this policy will be overturned and you'll find 33, 3400. So these are, you know, range-bound sideways type stocks. Similarly, Hero Moto 2800 buy, you know, 34, 3500 type of sell. Those sort of stocks these are, but wait for the fall to be over and the stocks to start turning around. It would be premature to buy right now, but, you know, autos are cyclical and this is cyclicality. You know, there was a time when there was no tomorrow and now, you know, they are aggressively competing. So that will give you buying opportunities at lower levels.
Okay. Mayuresh, just 3 minutes to go. So very quickly, same question to you. Would you treat this as a buying opportunity from a portfolio standpoint or just stay away?
So, Surabhi, I think the kind of management that has got put through specifically in terms of the Bajaj Auto management, they're clearly going to go after market shares. And in that respect, the kind of compromise that they'll do on the margins is very, very well epitomized in the kind of numbers that we've seen. Now, in terms of the product mix itself, I think you're probably looking at a very healthy mix coming through over the next few quarters. The Pulsar sales still holding out. The Discover 125 did disappoint as per their statement that they put forth. But I think the unit sales for a Discover, the entry-level bikes where the discount factor was pretty high, I think that has probably impacted margins along with input costs going higher. So from a long-term perspective, again, I think the export market's holding out pretty strong for Bajaj Auto. So I'll wait for declines probably to come on these counters. I think the kind of commentary has probably led to a fall in all other two-wheeler stocks as well. But I think the demand in terms of discretionary patterns should hold out. The volume growth should be reasonable and the margins should probably normalize over the next few quarters. But again, I think I'll wait for declines. Hero Motocorp probably remains one of my preferred picks.
And Ashwani, one more stock before we get into the close, and that's ITC. It's again approaching the top of the trading range. Now, what would you advise here? Is there a trade at all on ITC? Ashwani? ITC, yeah, ITC still closing strong and approaching the highs of its trading range.
See, you shouldn't think of, you know, ITC as a Bajaj Finance. I mean, when it's down and, you know, beaten up at 250, that's a good time to buy. Once, you know, this sort of GST news cheers it up back to 290, 295, that's more of a time to get out because it often tends to get into ranges. So getting in here means that, you know, you are about 40 points away from, you know, recent support. So that doesn't make sense. I think there are enough GST plays to be getting into, and consumer discretionaries and, you know, these consumer good type stocks would go much further.
All right, gentlemen, just hold on. Let's quickly count down to what's been a really great Monday for the bulls. You can't complain because you had participation from the headline indices. The Sensex is going to close above 36,700. So, yes, it's fresh all-time highs for that index. The Nifty is within kissing distance of that mark, just about 1.5% away from its own all-time high. The key thing is, can we actually take out this zone of 11,070? Is this a real breakout or not? We'll get to know, of course, in the days to come. But right now, starting off with the movers and shakers, UPL, the stock of the day, 16% up now that the deal overhang is done. That was a smart mover. The stock that we were just discussing, ITC, was a key contributor as well, 3.5% up. Since we're talking ITC, I just want to pull up its peers. It all started with the VST Industries numbers and the big rally that we saw there. That stock was up in double digits throughout the course of the day, 13-14% higher, even Godfrey Phillips. So generally speaking, cigarettes as a space was extremely hot today. Come back to the nifty biggies. Bajaj Finserv put on about 4%. Some smart moves on Maruti, by the way, 3.5% today as well. Largely speaking, materials and metals did all right. Vedanta 4% higher, Tata Steel, Ultratech Cement. A lot of these stocks have had a decent session for today. You can't complain too much with the financials either. ICICI Bank 3.5% on the higher side, SBI about 2%. Axis put on about 1% as well. Let's pull up the HDFC twins. HDFC has been kind of, sulking a little bit. It sat out of the rally today, as did HDFC Bank. So these two didn't quite participate. Other than that, we've seen some gains on an IndusInd Bank continue on. Bajaj Finance itself about 1% on the higher side. Asian Paints was worth noting, as was Lever. So the consumption engines were firing away for the market today, and some added gains on an L&T. What didn't work for the Nifty today, definitely the auto space, the two-wheeler space, that is. Stocks skidding off the radar. Bajaj Auto, again, look at the cut. 5% down after that huge fall that we saw last week. Hero Motors lost about 6%, and TVS Motors beyond the index also felt the heat today. Reliance as well, along with the HDFC twins. The other big heavyweight that chose to sit out of the rally today was RIL. Now let me move to the mid-caps very quickly. Decent breadth for the market, 200 points up on the mid-cap index, so can't complain. We've got over 1,200 stocks advancing, just about 840 declining. What worked? Let's start with the news play. So the GST play, Liberty Shoes, 10% on the higher side. Havells, 9% up. Of course, Havells also had the added sort of impetus of good numbers attached to it. That was another tailwind, 9% up on Havells. Bata, Khadim, 7.5% up on these stocks. Bajaj Electric fell quite a bit from the day's highs. Sharp fall from the highs, but nonetheless, still going home with a gain of about 5% thereabouts. Some of the hotel stocks were very excited as well, because now the GST that's going to be charged is on the transaction amount, not on the rack rate. So you had Lemon Tree, Taj GVK, a couple of these other names, EIH also on the upside today. Some other stocks that made headlines would be SpiceJet because of the arbitration award. So that stock was up about 4-5%. That worked out. Some of the paint names, Asian Paints, of course, from the large cap space. Its smaller peers like Shalimar were up about 4.5% as well. Decent day for L&T Finance Holdings. That has to be the mid-cap star of the day. 9 to 10% higher, with absolute disclosures with respect to the asset quality that they have showcased with the Ind AS transition. NCC, Adani Enterprises, Adani Transmission, Castrol, these were some of the other names that were extremely buoyant. So largely speaking, a good day for mid-caps. Just Dial is something that didn't work out. I mentioned TVS Motors earlier. Hathway is still down about 3%. So these were some of the names that were on the downside of the screen. We'll get chatting with the Vijaya Bank management in the next 30 seconds. As we do that, let me just quickly take final thoughts from our market experts. So, Ashwani, if you're still with us, your approach to tomorrow, given the big surge that we've seen today?
See, it would still be, sideways to up, because the big guns clearly failed to fire, Reliance, HDFC Bank. So from a, ranging market, it now becomes a buy on dip. So any dip to about 11,050, 11,070 would allow you to buy into the market. And basically the financials need to participate a bit more strongly, because these consumer rallies cannot lead the market up, because most of them are in the mid caps. So my sense is we should look for a test of 11,050, 70 for a fresh buy. Similarly, Bank Nifty, maybe 26, 950, 900, those zones, 50 to 100 point dip should allow you to buy. So now play for a bit of trend instead of the sideways play we were doing for many days.
Okay. All right. Mitesh, I'll take the same question to you. Okay, I think, Mitesh, so apologies for that. We do have the line through with the Vijaya Bank management, so we'll thank our market experts on that note. Right now, it's time to get some corporate conversations going. Vijaya Bank came out with some very strong numbers on the loan growth front. The asset quality has also been largely steady, minor improvement actually. We have with us Mr. R.A. Shankar Narayan, MD and CEO of the bank, joining in. Thanks, sir. Good afternoon, and thank you for joining in. So as I see the numbers before me, the gross NPA ratio has come down slightly quarter on quarter to just about 6%. Can you give us some of the details with respect to slippages and the restructured book?
As far as this quarter is concerned, we have no restructured accounts at all. And the slippages, whatever we had in March, that's there is no addition other than in one of the accounts, we had in road project, we had a slippage of around 100 crores. Other than that, this quarter has been pretty good as far as the gross NPA and net NPA of the asset quality is concerned. Actually, compared to March, the gross NPA is at 6.19, net NPA is at 4.10, and provision coverage ratio we have improved from 59 to 61. That 2% has definitely, we have provided higher, which our net profit at 144 crores could have been much, much higher, around 300 crores, and provision coverage ratio has been maintained at 59%. So overall, the bank has done very well. The bank has done very well as far as advances growth is concerned, around 31% growth. Total business is up by 25%. And operating profit is up by 13% at 852 crores. And net profit is at 144 crores. Capital adequacy is at 13.91. And provision coverage ratio is at 61.18. I must say the bank is one of the best performing public sector banks, and we will continue to do it quarter on quarter and year on year.
Okay. I just want to come back to the slippage point. So you said that the slippage number remains pretty much where it was at the end of the fourth quarter. The Q4 number that I have with me is slippages to the extent of about 1,600 crores. Can you tell me the absolute number at the end of Q1?
Opening NPA was 7,526 and closing figure is 7,579. And additional slippages were 1,002 crores and recovery and upgradation is about 949 crores. So technically, the slippages and recoveries are almost at equal level, which the NPA figures, if you see the gross figures, it is 7,526 versus 7,579. So, and net NPA is much lower with higher provisioning also.
So, sir, how do you see or where do you see the NPA numbers stabilizing? What's the trajectory that we should expect over the course of this year? You're at 6% now.
As far as Vijaya Bank is concerned, we are very confident that not many accounts are causing concerns. All the accounts, whatever we have, both on retail as well as corporate, they are all performing very well, even as per the new RBI definition of T+0. And we are very confident that going forward, the reductions in gross NPA as well as net NPA will be much better than what we have shown in June also.
Sir, I just want to understand the exposure that you have to the SME segment. And is there any stress building up there? I mean, this flows from comments that we got from the Kotak Mahindra Bank management about the issue of collaterals and whether there's a case of overvaluation and maybe some stress, incremental stress that could start showing up in the SME book.
On SME book, our current NPA, if I break up the NPAs into segments, under agriculture, I have 663 crores NPA. Under MSME, I have 1,095 crores NPA. Against the total, in agriculture, I have 16,200 crores exposure, of which 600 is the NPA. Under MSME, 18,000 crores is the portfolio. 1,095 is the NPA. That's hardly out of 18,000 crores. 1,000 means it's about 6% to the gross advances. And we do not see any pressures building up over there also. And in corporate, we are not seeing any fresh NPAs or slippages. Overall, we are much better than the figures what the other banks are showing, including the private sector.
So no reason for,
all the segments,
you
whether
to
it
stress...
is agriculture, retail or MSME.
So no reason for you to stress about your SME exposure, even with respect to the kind of collaterals that you're right now working with?
Yes, our experience has been pretty good under this segment also. We don't see any pressures of NPAs or slippages.
Okay, I want to move to the loan growth, sir, which is a very sort of healthy number, 28% growth in advances. Where is this growth coming from, and do you see these kind of numbers sustaining?
Say in loan, year on year, we have grown about 31%. The main growth has been, I would say, we are currently around 1,26,000 crores loan book, which when I took over, it was somewhere around 93,000 crores. the 30,000 crores what we had, 15,000 is from retail, 15,000 is from corporate. Out of 15,000 growth, what we had in retail, it is mainly housing loan and mortgage loan, which is well secured by mortgages. Under corporate, we have mainly loans to state government, public sector undertakings, and AAA rated corporates, and we do not take any credit below BBB rating. So I can be very confident that whatever growth we had are recorded in last 1 year, it has been well secured, reasonably absolutely safe, and they are well rated both by internal rating as well as external rating.
Okay, loan growth is fine. Asset quality, you seem reasonably confident. Let's come to margins then, sir. If you could just tell me, where are you at? I think the margin number was about 3.1% at Q4. Where do the margins stand now?
As on March, our margin was, NIM was 3.10. Today it is 3.12. And we have been maintaining this 3+ for last 3 or 4 quarters, and we are confident we will be maintaining same margin above 3 for next quarters and next year also.
That's very healthy, sir. One must compliment you. I'm sure your shareholders will be very happy, because some of the other banks that have reported so far, they're showing a little bit of a pressure. The yield on advances seems to be under strain. No such concerns for you? Do you see this 3% margin band continuing?
It will continue. We are very confident, and we will improve on it. Actually, if economy turns more positive with more NPA accounts getting resolved for the industry, I think Vijaya Bank will definitely do much better than what we have done so far.
That makes me come to the last question now, sir. If you could just share your NCLT exposure with us in list 1, list 2, in case you have any exposure, and the recovery that you're expecting from this.
NCLT totally, we had 7 accounts in first list, 3 accounts in the second list. Totally 10 accounts amounting to 1,300 crores. And of which 2 accounts have been resolved. We are hopeful that remaining 8 accounts also will see some positive resolutions going forward before September. But our recovery department is not only concentrating on NCLT, but also on other NPA accounts. The entire 7,500 crores portfolio what we have a daily follow-up, reviews, and meetings with branches, regions, and the customers also. We are sure things will be more positive for Vijaya Bank going forward.
Okay, sir, just a final point on capital requirements. With this kind of growth, I mean, you've got 30% loan growth. What could the requirement be in the foreseeable future?
As far as the capital is concerned, we are at 13.91% today. Technically, I can manage another 20,000 to 30,000 crores credit growth as far as current issues are concerned. But we have room. We have taken board's approval to raise additional Tier 1 or Tier 2 bonds as and when it's required.
And how much are you expecting from the government, sir? How much is total requirement? And out of that, how much do you expect by way of government, perhaps additional recapitalization?
Recap, we have not taken at all. We got the growth capital from Government of India, around 1,277 crores last March. But for current year, we do not expect any additional capital infused by government. We can manage it with our internal accruals, because we are confident of making 1,000 crores net profit for the current year. Plus, we have enough room for AT1 and Tier 2 bonds. We will use these instruments rather than going for equity alone for capital requirements.
Okay. All right. So we'll leave it on that note. Thanks very much for joining in with the details. That's Vijaya Bank. Seems to be a very solid sort of quarter for them. No problems on asset quality or on margins or on loan growth for that matter. Let's take a quick break. All the commodity market action coming up next with Manisha Gupta.